fixed deposits particularly were turning out to be a safe but very poor return investment, because there's a tax factor as well on that, right? So my journey in in investing in bonds or corporate bonds, corporate debt, so to say, started not very long ago. Maybe around 2 months back was the first time when I bought a corporate bond. Well, to be honest, primary factor being diversification. So while I have been active in the equity markets for maybe more than a decade now, and since I was staying in a tax-free environment before this, so even fixed deposits used to make a lot of sense from a fixed income perspective because they used to be tax-free. But now, since I am not holding the NRI status anymore, fixed deposits particularly were turning out to be a safe but very poor return investment, because there's a tax factor as well on that, right? So I was looking at safe investments which can generate close to a double-digit return, and that's what was very attractive about corporate bonds in India at this point in time. So my first investment was with RDC Concrete, which was giving close to 14% yield, and that was quite attractive. It was sitting beautifully on the risk-return curve. So this is 60-30-10 sort of a portfolio within the debt is what I wanted to follow. So 60 should be in safer bonds, which are probably giving around 8-9% interest, but are a AAA rated bond per se. Then there's a 30% where you can take a little more risk and try to get around 9 or 10% return on those. And there is 10-20% which is on the risky but high return bond investments.